I know this is commonly said on YouTube, but I truly mean it when I say it. I do believe that what you're going to watch in this video is going to blow your mind and it will change your investment strategy forever. When I found out about this, I completely changed all my investment approaches. I'm now way more concentrated in my bets for good reason. Let me show you what I mean. Have a look at this chart. This is the German stock market index relative to the American stock market index. So it's the German DAX relative to the S&P 500, which underperformed over the course of 55 years by 51%. I also lived in Hong Kong for a while, for over 10 years. So have a look at this. This is the Hong Kong stock market index, the Hang Seng, relative to the S&P 500. This underperformed by 70% in the last 40 years roughly. There's a lot of people watching from Europe. Have a look at the UK stock market index. This is the FTSE relative to the S&P 500, an underperformance of 53%. And that's only in the last 8 years. What about the Japanese Nikkei? Also an underperformance in the last 8 years of 14%. Let's generalize it a little bit. Let's have a look at a low-cost MSCI World ETF. Ticker symbol is URTH, again relative to the S&P 500, a very constant underperformance if you invest into the entire world versus just the US, an underperformance of 30% over the course of 12 years. So is the US going down anytime soon? I don't think so. Capital is concentrating towards the US over the years. And so what we can already take away from this is that it is truly a winner takes most game. As in so many areas in life, right? There are a few winners that reap most of the rewards, and the vast majority of players in any kind of market tend to not do too well. Geographically, in terms of economies across countries, the US is among the very few winners. If you spray and pray across the world with your investments, you're very likely going to do poorer than simply just pouring your money into the US. That's learning number one. But this is not where the whole learning is stopping. Again, returns are concentrated, and they are way more concentrated than most people think. Because actually, the S&P 500, the US stock market, isn't really doing that great. This is the S&P 500 relative to the US money supply, relative to USM2. And the gains are pretty much non-existent, right? The S&P 500 is a price index, not a performance index. So yes, on top of that, you also get dividends, but you also get fees on top of that. You also get taxes on top of that. So really, relative to monetary expansion, relative to money printing in the US, you're actually not gaining that much by buying US stocks. So how is that possible? How is everybody losing? How is even the one stock market that's outperforming everything else over the decades, how is that barely keeping up with monetary inflation? Again, the answer is that returns are highly concentrated. Where are they concentrated? I believe they are mainly concentrated in technology, in US technology, in technology stocks that have global monopolies on everything. Check out this chart here. This is the Nasdaq 100 relative to the S&P 500. So this did outperform long term. Of course, we have our pump and dump. This was the dot-com bubble, but over the decades, a very nice long-term outperformance. And of course, this also works with monetary expansion. This is the Nasdaq 100 relative to US money supply. So measured in US dollars that are floating around, if we adjust for that monetary printing, then it's the US tech stocks that make all the gains. But again, we are not yet done. Returns concentrate across the few winners. And that concentration is scary. Let's have a look at the Nasdaq 100 returns. Year to date, the Nasdaq 100 went up by 15% in US dollar terms. Let's have a look at the constituents of the Nasdaq 100. How many of those stocks made more than 15% per annum? We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. 3/4 of the stocks within the Nasdaq 100 did worse than the benchmark. Again, because returns are concentrated. Had you bought German stocks, you'd be doing poorly. Had you bought Hong Kong stocks, same thing. Same for the UK, same for Japan, same for the entire world, and even the US stock market barely kept up with monetary expansion. If you're buying Nasdaq 100 ETFs, you're doing fine. But if you pick an individual stock within the Nasdaq 100, you've got a 75% chance roughly to underperform because all the money is flowing into Nvidia and Netflix and Facebook and Qualcomm and Google and Amazon. Those names aren't really surprising names, right? It's actually not that hard to find the outperformers. It's simply the companies with global monopolies. It's the companies that own the platforms that you and me are dependent on. It's the companies that own YouTube. It's the companies that own your Apple phone. It's the companies that run the servers in the background like Amazon. It's the companies that have all the pricing power, that own the infrastructure of this economy, that have super safe profit margins. The trends in this video are not short-term fluctuations, right? We looked at multi-decade trends that tended to be very consistent over time. We looked at trends over 20, 30, 40 years. When you're investing, not just for the next year, but for your retirement, be sure not to be caught up in the wrong place. Most companies struggle to survive, and a few investments rake in all the profits. It's actually not that surprising when we think about this intuitively, right? We always want to get the best, right? Why do you own an Apple phone? Or why do you own a Samsung phone? Or why do you use Windows or Mac OS? It's because the best product on the market. It's because it's the best value for money. If you're caught in the middle, you're fighting with the masses. If you have a differentiator, then you get most of the gains. And so this is the consequence I take from those charts. I personally don't spray and pray. I don't buy Disney stock. I don't buy McDonald's stock or Coca-Cola. I rather buy Google and Amazon and Microsoft. And yes, this has more volatility, but that's fine with me because I invest over the long term. And you can even diversify away from volatility with other investment classes, right? By also having some levered property, by also having some Bitcoin, by also potentially even owning some gold. You can't really diversify within the stock market anyway, right? Within the stock market, there's a lot of correlation as well, similar to crypto, right? When Bitcoin goes up, all the altcoins go up as well and vice versa. The same is true for the stock market as well. The prices of stocks go up and down at the same time anyways. So if you sell some of your Nvidia stock in order to buy some Coca-Cola, you're not really getting any more risk off. When your Nvidia stock is going down, then your Coca-Cola stock is probably also not doing that well. Buying companies that do not have a global technological monopoly is something that costs money. If you're willing to pay this, is up to you. But at least be 100% aware of those opportunity costs. Global stocks aren't doing as great as Apple or Amazon or Netflix or Nvidia or Qualcomm. If this was indeed an eye-opener for you, then feel free to share this with your friends. Feel free to also give it a like because it helps the channel grow. And of course, if it's your very first time, feel free to subscribe as well. I publish videos regularly. If you've got Telegram, feel free to join us as well. The link is down below. If you want to know what I'm personally buying, feel free to also check out the premium membership. This is also where you can get one-on-one access to me, where you can chat about your investments. So feel free to check it out, thebitcoinstrader.com. See you over there as well. Cheers.